SoFi has had a torrid week with the stock selling off 21% since they reported their first earnings as a public company last week. The stock price is now down 46% from its high back in February and around 42% in the past 6 months. Now, what is happening with SoFi is, in my opinion, it is quite clearly a high quality business playing in a very large addressable market. Obviously has the new and unproven public company element to deal with, which can make a stock price obviously very volatile in the near term and then subject to big changes when they do report things like quarterly results. So there is that. But what we're focused on, as we say all the time, is the business and its progress towards reaching its goals and objectives. So we're going to dive into SoFi's latest quarterly results and see if we have reason to either be concerned or just see if the sell-off is unjustified. For disclosure, I do own shares in SoFi at the moment. I've done a few videos on the company previously as well, which lays out my thesis and dives deep into the company and what it does. So I'll leave a link to them down below if you need more info on what SoFi does and why I'm invested. But if not, let's get into this quarterly summary that we see here. So first of all, just a recap on SoFi's mission, because I do like it, to help our members achieve financial independence to realize their ambition. Something that I'm really on board with and one of the reasons why I decided to invest in the company. But first thing I want to look at here is their members growth. And it's quite outstanding if you look at the trend line that we can see here. So year over year growth has been improving every single quarter, scaling up from around 37% back in late 2019 to 113% in its most recent quarter. So it's now at record membership growth. Now, what's also interesting is, yes, they've reached 2.5 million members, as we can see here. And although that's quite impressive, it's really a tiny capture of what is possible for SoFi in the US and also internationally. So for reference, Square's Cash App has almost 40 million active users. And then we have an even more extreme case in the likes of PayPal, which has close to 400 million active users. Now, these three companies offer slightly different products and have a slightly different appeal, but the point is they all appeal to the same sort of consumer. So it wouldn't be out of scope to say if SoFi could execute in the right way, bring out the right products, that they could have a membership number close to the likes of Square or PayPal in the very long term. And from my experience, what you see in these type of companies is a members first mentality, then monetization. So focus on monetization last. Make sure you bring the members over first. Get them onto a sticky platform, sticky product that they get using, and then focus on monetizing all of those members thereafter. But with that being said, SoFi still have a fairly good average revenue per user number, something that will compare with the likes of Square later in this video to get an idea of where this company could be revenue-wise. Now, next is the financial performance, which was strong as expected, driven by high user growth and product usage growth. Record quarterly revenue, as you can see here, 237 million in one quarter, up 74% year over year, which is a very high growth rate, especially versus their target that they set out. But they also had positive adjusted EBITDA for the fourth quarter in a row, and adjusted EBITDA really is just their measure of core profit once accounting for all non-recurring items, and usually it's something you see with these younger companies who have a lot of things like stock-based compensation and other one-off or non-recurring costs as that. But definitely, very good to see 4 quarters in a row now they've been able to produce a profit. And for a company that was essentially a SPAC and is still very much in growth mode, it's definitely a positive sign. But probably the most telling infographic in this financial performance is their annual performance chart that we see here. We can see a 3.5-year positive trend line down from back in 2018, 240 million of revenue up to 852 million of revenue for the last trailing 12 months. Now, remember, the last trailing 12 months is just the last 2 quarters of 2020 and then Q1 and Q2 this year. So, for that dollar amount growth that we can see here from 2020, 621 to 852, that's definitely an impressive amount of growth. EBITDA, although not a focus at this stage, has been positive for the entire trailing 12 months with a rough 7 to 8% margin. And that's great, but the main focus really for me is this revenue number here, seeing them hit, close to $1 billion in revenue already, especially when they've had some headwinds in the quarter that they note as well. They had 30 million of interest expense that had to be written off, and then 4 million related to their investment in Apex Clearing. So, they've had some headwinds, but they're still managing to grow very quickly year over year, and the dollar amount growth is impressive as well, nearly at $1 billion, like I say. Now, here they're showing us their performance versus the guidance that they gave, in which they beat by around 10% to 8% on the top line, and then 8 to 4% on the bottom line. And this is obviously a bit of a flex on their part, but an important one when you factor in that the stock is down around 20% since it reported these earnings, and the rumoured cause was to be the slightly weaker Q3 guidance that they gave on the bottom end, on the adjusted EBITDA side, relative to what analysts were expecting. And they do explain, that they expect a short-term headwind from the moratorium on federal student loan payments not ending on the 30th of September like they thought it was. And this is a contributor, I'm guessing, but still, guidance on the top line is relatively strong, 245 to 255 million in one quarter. Again, it will make it their record highest quarter ever. So that's still a very positive thing for me. And if you listen to their call, for the most part, they're very confident in their long-term 30% or 45% profit margin on the EBITDA side that they put in at the start of this year. But for now, they are definitely more focused on product and user growth that will create long-term shareholder value rather than small profits in the near term. In reality, 3 million in adjusted EBITDA isn't exactly going to move the needle now. We'd much rather them, as shareholders, put money and put time and effort into creating long-term value for the company. Now, another important slide was their reiterating of the 2021 guidance that they set out. So they did reiterate at the start of this year, when they went through the SPAC merger with IPOE, that they would reach 980 million in adjusted revenue by the end of the year, that we can see here. That was 58% annual growth. And they're keeping to that revenue despite the headwinds that they note here. They're losing around 40 million from the moratorium and around 12 million from the anticipated revenue from Apex. So they've got some headwinds there, around 62 million worth when you put that into dollar terms, but they still think they're going to hit these targets. 980 million on the top line, 266 million contribution profit, essentially suggesting to us that their products are very profitable on a direct cost basis. And then they've got this adjusted EBITDA guidance of 3%. All in all, 58% revenue growth, 27% contribution margins. Not bad guidance. And then just lastly, to look at the segmented results, because I do think it is, another positive, and it's good to see mostly here that we have Galileo, which is a technology platform part of the business, is growing at a very big clip. We can see that it doubled in the last 12 months versus what it did in a full year 2020. So it's growing at 100 to 150% clip, that seems to be. Now, what's important about that is it's diversifying away the business from just being a pure lending product. As we can see here, the majority of net revenue is coming from all of these lending originations that we can see. So it's good to see that Galileo, which they bought for around 1.2 billion last year, is growing very quickly. That business now is probably worth close to 3 billion alone. So it looks like it was a very good investment. And I think it's one that will add a lot of value to the company in the future. Financial services, obviously something that will take a little bit longer to monetize fully, but it's growing fast, mainly because of its user and growth acquisition. And remember, in a nutshell, that SoFi on their forecast, their 5-year forecast, they only expected to grow at 43% compound annual growth rate. And I say only, that will obviously be an impressive 5-year growth rate. But they also want to achieve a 32% EBITDA margin, which they're holding to. On the investor call, they said they still believe firmly that they will achieve that in the future. But the main thing here is the growth of the company. All right, profit will come obviously later in the day, and it does affect the models and the DCF if we don't quite hit these targets in the years that they say they're going to achieve them. But the main thing, of course, is this terminal value and what the company will be worth in 5 years' time. And if they're going to be growing at, or expecting to be growing at, a 43% clip, they're growing close to 70% at the moment, 55 to 70% year over year on an annual basis, and they're reaching profitability on an annual basis whilst investing back heavily into the business. So all in all, I think I'm more than happy with the business, more than happy with its progress, and so therefore I will be happy to hold my position. They're still on track for all of this that they've mentioned here, and this is the top quartile. So this is the best case scenario. It makes the stock seem significantly undervalued from where it is now. And so on that basis, I would say the recent sell-off, 20% sell-off, is definitely unjustified, especially if the main reason for that sell-off is that they gave weaker than expected guidance for the next quarter on the bottom line. In my opinion, we shouldn't be too worried about marginal points here and there on the bottom line at the moment. What we should be focused on is if the business is getting better, if the business is growing, which it is, and creating long-term value for us shareholders, which I believe that they are. So another interesting development this quarter with SoFi is the fact that it's attracted some super investor buys. Now I'm on Dataroma, which tells you, a bunch of super investors what they've been buying in the most recent quarter. And we can see here that it's attracted the attention of Dan Loeb and Bill Miller, both very well-respected super investors. Dan Loeb, for instance, has made it 3.25% of his current portfolio, which for him is a fairly large position given he has over 125 stocks. His approach, although it is, more event-driven, it is value-orientated, and they do tend to trade in and out of positions after, a 2 to 3 year period. But he is a very successful investor, and he has opened a sizable $500 million position. So I just thought, that was an interesting landmark for SoFi, with it being, one of these SPAC companies that wasn't necessarily attracting attention from super investors. SoFi is definitely one of the first to have some big names backing it. And so there you go, guys. Just a quick update on SoFi, running through their quarterly results. I know I went through it fairly quickly, but like I said, it's just an update. I've covered this company many times before. If you haven't seen that before, then go and check that out in the description below. I will also leave a link to the Patreon as well, which you can check out to get access to all of my valuation models, including this SoFi scenario analysis one here. You'll also see some earnings updates that I've done on Proterra and Alibaba, and I'm planning to do a more expansive one on SoFi, Palantir, and Opendoor very shortly soon on there. So go check that out. But apart from that, guys, leave a like on the video if you enjoyed it. Comment, let me know what you think of the recent sell-off in SoFi, and I will see you in the next one. Good luck with your investments.